We are pleased to welcome you to our event today, Decarbonizing Finance, Beyond Divestment Investment with Paddy McCully of Reclaim Finance and Sandy Emerson of Fossil Free California. Well, we welcome you to post in the chat where you are zooming in from and a little bit about yourself. And before we start, just a reminder that we are recording. Also, we want to acknowledge that SF Bay PSR is located on the unceded ancestral homeland of the Ramaytush Ohlone peoples, who are the original inhabitants of the San Francisco Peninsula. And I'd like to tell you a little bit about San Francisco Bay Physicians for Social Responsibility. SF Bay PSR organizes physicians and other health professionals to defend health and demand racial, social, and environmental justice. By combining the power of community activism with the knowledge and credibility of health professionals, we promote public policies that support our intertwined areas of concentration: environmental health and climate crisis, nuclear weapons abolition and diverting funds away from warfare and toward healthcare, social and racial injustices, and the health burdens of vulnerable communities, and education of the public and the next generation of health professionals. Our 2021 event series focuses primarily on deepening our understanding of the connections between these core issues. Please join us on June 28th for our next Divestment Investment Task Force meeting. On August 3rd, we are co-sponsoring an event hosted by City Lights Bookstore, celebrating Dr. Rupa Marya of UCSF and Raj Patal's new book, Inflamed: Deep Medicine and the Anatomy of Injustice. Look out for more info on events on August 6th and 9th, commemorating the nuclear bombings of Japan. Also, our next racial equity reading group has a new date and time, August 25th at 7:45 p.m. And save the date. Our annual gala will be on September 22nd with Daniel Ellsberg. Please, we hope you can attend. To learn more about events, readings and resources, policies, and how you can donate, please visit our website, sfbaypsr.org, sign up for our newsletter, events, and action alerts, like us on Facebook, and follow us on Twitter, Instagram, and YouTube. As you listen to the speakers, please post your questions in the chat or hold them until the end and you can ask in person. During the Q&A, we invite you to show your video and join the discussion. We hope this event will be an opportunity to build community. Now, I would like to introduce Dr. Bob Gold, Board President of SF Bay PSR. Bob.
Greetings, everyone, and welcome tonight to our latest in a series of webinars that we've had, and this one being on Beyond Divestment. And first off, really want to thank you, Julie and Tara Weeks, for all your exceptional work organizing this webinar. We're very excited to have two wonderful speakers tonight to teach us how we could move towards decarbonizing finance globally as well as in California. Climate change driven by fossil fuel emissions represents a grave threat to human health as well as worldwide economies. The fossil fuel sector, which we understand is largely that of coal, oil, and gas sectors, include companies that extract these elements from the earth and or refine and consume them. Ending financial support for fossil fuels from banks, investors, and insurers would encourage industry movement towards non-fossil fuel energy and energy development. Investment in green and renewable energy will decrease the cost of such energy and thus increase demand. Decarbonizing finance is key to our efforts to end the climate crisis and build a just and green economy. Globally, the movement to decarbonize finance is taking off. According to Yale Climate Connections, quote, worldwide, 66 financial institutions and insurance companies have formally decided to eliminate or significantly reduce their financial support for oil and gas drilling, and 131 companies are divesting from coal mining and or coal-fired power plants. So we'll kick it off with our first speaker. I'd like to make the introduction to Paddy McCully. And thank you again, Paddy, for being with us here tonight. Paddy is a climate, energy, water, and human rights analyst and campaigner. Before joining Reclaim Finance as their energy transition senior analyst, he was the climate and energy program director at Rainforest Action Network. And before that, he was executive director of BlackRock Solar. He spent 16 years at International Rivers, supporting communities around the world impacted by destructive dams. He was a member of the UN Environment Programme's Dams and Development Project and a member of the advisory board for the South Asia Network on Dams, Rivers, and People. Far in the distant past, he was a co-editor of the Ecologist magazine in England, as well as an editor for Instituto del Tercer Mundo in Uruguay. He is the author of the book Silenced Rivers, The Ecology and Politics of Large Dams. Paddy, we're really looking forward to your presentation, and again, thank you for being here.
All right, thanks very much, Bob. And I will just share my screen and put myself onto slideshow mode, and fingers crossed the tech will work. Now, can everyone see my slides okay? Not hearing otherwise, I will proceed. I see a couple of thumbs up. Okay. Yeah, so as you heard in the introduction, I'm a senior analyst with Reclaim Finance, which is a Paris-based organization. We're very new, just over a year old, and set up basically to make finance work for the climate. And yeah, one of the very few organizations worldwide that's really focused on climate and finance, and specifically fossil fuels and finance. I only have 15 minutes to really explain the entire global financial system and how we're going to decarbonize it. So I will get a move on. So I find when trying to get a grip of the world financial system, it's very useful to break it out into these four main pillars, which helps understand really where the power and the influence lies. And sort of on top of these four are the asset owners, and then under them, commercial banks and asset managers and insurers and reinsurers. And reinsurers are these huge companies who actually insure the insurers. But it all gets it's sort of simple like this, but gets rather complicated, because while the asset owners all own these other three pillars, in terms of owning their stocks and bonds, there's a lot of interconnections between them all. The commercial banks also have most of them have asset manager arms, and through those asset managers are owning the other asset managers and owning the insurers and reinsurers and owning other commercial banks, and the asset managers themselves have a similar relationship. The insurers are actually major asset managers and asset owners. And so sometimes it's better to think of it as snakes rather than pillars, from the perspective of them all being so intertwined. But these four different types of entities do have unique roles, even if they all get very much intertwined with each other. To who are the asset owners? So it's pension funds, university endowments, insurance companies. All these logos are asset owners that are all part of a thing set up last year called the Net Zero Asset Owners Alliance. So these are the more progressive of the asset owners around the world that have committed themselves to net zero emissions in their portfolios by 2050. and they'll say a little bit more about what that means. And there are similar bodies now being set up for these other the other pillars of the global financial system. You will notice in this, among all these logos here, there's very few US institutions, which sadly is usually the case when you're looking at who are the more progressive institutions inside finance. But one you will see down in the bottom left there is CalPERS, the California State Pension Fund, which is the biggest state pension fund in the country, a major and very influential investor. And I would say, I think without being too unkind, they do talk a good game, and climate are involved in a lot of climate initiatives. But I think people that actually work on CalPERS from a divestment and climate angle often left pretty frustrated by their actual action, but it's a story for later. And then just who owns financial assets around the world? Well, the biggest pool of assets anywhere is the pension funds, something like $54 trillion in pension funds around the world. And followed then by the insurance companies at 31 trillion, also a massive massive amount of assets there and massive financial power. And then there are sovereign wealth funds, which are basically government owned and run funds. A lot of them actually based on oil money. So Norway, for example, has a huge pension fund where they have been very wisely putting away a large part of all the money they've made from their oil and gas wealth, put it into now, I think, over $1 trillion sovereign wealth fund. And similarly, a lot of the oil producers in the Gulf have sovereign wealth funds, but other countries and places have them. They're not all oil related. And then you see nonprofit endowments, including universities and other. A lot of the attention, a lot of the campaigning on divestment has focused on those nonprofits for various reasons, but the actual amount of money there is, they have less weight than these other pools of money. And then there's a huge unknown really about the sort of the mass affluent and the super rich worldwide, hugely varying estimates for how much money they have, including because a lot of that money, when you come to the super rich anyway, a lot of that money is in tax havens, and there's certainly many trillions in tax havens, but because of the nature of that money, nobody actually knows how much. So these asset owners, they have huge amount of assets. I mean, they literally have all the investable assets. So what can they do in terms of pushing on climate change? Well, they can implement robust fossil fuel exclusion policies on coal and oil and gas. Those three fossil fuels are responsible for basically 75% of all our greenhouse gas emissions. So if we're going to deal with climate change, that's where we have to look. And once they have those policies, they can engage with the companies that they own, ask the companies politely to change their ways. But as we've seen from years of experience of this happening, the fossil fuel companies don't really do very much when they're politely asked to change. So it is really important that the asset owners then vote when shareholder resolutions come up, which are calling on fossil fuel companies to act on climate. It is really important that asset owners vote the right way. There has not been a great record in the past of that happening, but that is changing, and votes are more often going the right way. And very importantly, what's happening more often now is that shareholders are voting against board members. And I think this is a really promising trend. And we saw it in particular this year with Exxon, where 3 of Exxon board members were voted off and replaced by supposedly more climate concerned board members. So, you know, these board members earn a lot of money being in these positions in big corporate boards. And I think this is quite a big stick hanging over them now. And I would hope that there's a lot of fear that if companies don't start moving quickly enough, then board members will start moving their jobs. And of course, if if these asset owners are engaging and they are voting and companies are still refusing to move, then there is the divestment option, and that has to be on the table and it has to be serious, or else companies will not take the pressure seriously. And then the other important thing is for asset owners is to instruct the asset managers. Asset managers, which I'll go to shortly, are managing a lot of these funds for the asset owners, have a lot of power, and often will say, well, we are only managing the money, we don't own it, so we're not going to do anything. So it's really important the asset owners actually instruct the asset managers to act on climate. And we've seen a lot of cases where the asset owners say, oh, they want to move on climate, where the asset managers saying they want to move on climate, but the asset managers say we're not going to do it because we're not hearing from the owners of the assets. So that communication has got to get better. So who are the asset managers? With this particular list of logos, this is just a selection of some of the asset managers that are involved in another initiative called the Net Zero Asset Managers Initiative, as opposed to the Net Zero Asset Owners Alliance that I mentioned earlier. And you can see that the big three and the big global asset managers, so BlackRock, which is the big daddy of all the asset managers, with now something like $8.5 trillion under management. They are part of this. Also Vanguard, which is number 2 worldwide, State Street, which is number 3 worldwide. And just between those 3 companies, you will often have about 20% of the ownership of just about any public company worldwide that you look at. So they have a lot of power to shift votes on companies and to push companies in climate friendly directions. So what can asset managers do? Engage, vote, divest, similarly to the asset owners. They can talk with the asset owners and develop together fossil-free investment policies and strategies. Another really important thing they can do is that they need to solve what is often called the passives problem. And what this means is that rapidly growing proportion of all invested assets are in the passive funds, so index funds and exchange traded funds. And anyone who has a 401k or 403b may well have money in those index funds. And the asset managers, when you pressure them to say, okay, you got to divest from coal companies, they'll say, well, we can't because we have an index that tracks the S&P 500. And so if there's any coal companies in there, we just have to invest in them. But from our perspective, that is a totally voluntary policy that they've adopted to track any particular index. And it's a bit like saying, well, I have a policy of eating 3 donuts a day, and so I can't lose weight because I have this 3 donuts a day policy. But the answer to that is change your policy. And similarly, this is what needs to happen with the asset managers, and they can come up with fossil-free index funds. They can have default index, fossil-free index funds, so that people are automatically put in those funds rather than fossil fuel containing funds. So that's, although it's held up as a major obstacle to finance acting on climate change, it really doesn't need to be. And then the third pillar is the private banks, who are, a key part of capitalism and also a key part of fossil fuel finance. There's a report that Reclaim Finance is involved with every year, and Rainforest Action Network in San Francisco is the lead producer of this report, called Banking on Climate Chaos. And these numbers are from the last version of that report, came out in March, and you see 60 biggest private banks worldwide provided almost $4 trillion in financing for the fossil fuel industry in the 5 years since the Paris Agreement. And if you look at the graphs, you can see that fossil fuel financing from banks was increasing year over year until last year. Because of COVID, sadly, it took a tumble, but still to a higher level than 2016, the year after the Paris Agreement was signed. And we are very concerned that growth trend is going to start again in as we recover from COVID. And then if you look at the chart on the right, you can see that by far the biggest bankers of fossil fuels worldwide are the big US banks, particularly JP Morgan Chase. Although in recent years, Citi has been catching up with them. So there's been a lot of campaigning on banks, really going back 20 years or so, and stepped up, I'd say, particularly in the last 5 years, with a lot of groups in the US and internationally getting involved and pressuring banks in their countries and regions. So there has been a lot of policies now adopted, fossil fuel exclusion policies adopted by banks, and they're coming at a pretty rapid clip now. Sort of policies that cover more areas and policies that are steadily improving, but we still have a very long way to go. This shows who have the best policies basically on fossil fuels. The dark color here in the bar chart are coal policies, the red are oil and gas, and you can see we're a lot further along in terms of getting coal policies in place than we are oil and gas policies. And when you look at the amount of money invested in fossil fuels worldwide, coal is far under 10%. It's a very small proportion of the amount of money. So you can have action happening on coal, but not having much impact upon overall money going to fossil fuels. And also, by far the worst funders of coal are the Chinese banks. Is actually, I think, the top 11 bankers of coal worldwide are all Chinese. And although when you get to number 12, I think that is Citi. It's the worst non-Chinese coal funder. And then there's also set up recently a net zero banking alliance. Pretty unclear. Is that really meaningful? Is it going to do anything? I mean, they don't really even have a logo at the moment. But we will see. Hopefully some pressure can be put on them to actually make that meaningful. And then lastly, the insurers. And these are the entities that are supposed to manage risk for society. But when it comes to climate change, they're creating the risk as well, because they're insuring the fossil fuel companies and their projects, and they're investing in them. And while the bank campaigning, private bank campaigning, goes back around, say, 20 years, insurance campaigning is much newer, really just the last 5 years or so, but has been really successful, has achieved a lot, especially in Europe. And there are now 60, it's now over 60, because there's sort of wins happening almost every day, 60 big insurance and reinsurance companies that have divested from coal, and some of those also from tar sands. And then even more importantly, there's 26 of these major companies that have limited or ended their insurance coverage for coal, and some for tar sands. And I say it's more important on the insurance and reinsurance coverage front than on the investment or divestment front, because when it comes to investment, there's a lot of other options. There's a lot of other companies that can, asset owners and managers that can put money into the fossil fuel industry. But when it comes to insurance, there's nobody else can do it. So when insurance is out of the sector, it's hard for them to continue, with the proviso that for some of the very biggest companies, and especially biggest oil and gas companies, that they have the capacity to self-insure. So that's a wrinkle in the campaign theory here. In the US, the campaign started up a couple of years after it did in Europe, and the progress is behind where it is in Europe, but there is progress happening. And some very active campaigns. So two big targets right now in the US are Liberty Mutual and Chubb. Chubb's actually a sort of a Swiss US company. But it's a really interesting campaign, and there's quite a lot of evidence that, especially in the coal sector, that coal companies are finding it increasingly difficult to find insurance, and that their insurance rates are going up a lot, and that is causing problems. And we're starting to see signs the same thing is happening with tar sands pipelines, and particularly this Trans Mountain pipeline in Canada. There's a whole bunch of other players which don't make it into my top four, but are also really important in that there is campaign happening on them. You know, there's the big public sector institutions, very important at the global level, and also central banks and regulators. And there's a lot happening now with the Fed, other central banks around the world to make all these institutions play a role in decarbonization. So those are the institutions that campaigners are targeting and that are announcing a lot of initiatives and policies with varying degrees of seriousness. So what are our key demands? You know, overarching demand is finance must align with 1.5, which is this sort of, it's a talismanic statistic, 1.5 degrees Celsius of warming above pre-industrial levels. And that's the level over which the UN's Intergovernmental Panel on Climate Change says is sort of things start to get really disastrous and really hard to come back from. And if we're going to align with 1.5 degrees, that means in particular, first priority has to be stop financing expansion of fossil fuels. We've actually been saying this for years. This little chart on the right was developed by our friends at Oil Change International in DC. And based on IPCC and other data, they show that just the already developed reserves of fossil fuels, so the fields of oil and gas that have already been opened and where extraction's already been happening, just with those reserves, there's enough carbon there to blow up our 2-degree carbon budget, never mind our 1.5-degree carbon budget. So clearly, if you're in a hole, stop digging. If you're in a climate crisis, stop expanding fossil fuels. And then beyond that, of course, we need a rapid phase out of fossil fuels, starting with coal, then oil and gas, so that we're basically done by 2050, but with a 50% cut in overall emissions, not just from the energy sector, from all sectors by 2030. And then on the sort of positive side, people like to talk about divest and also invest. We need, this is from the International Energy Agency, 3.5 times increase in clean energy investment by 2030. It's a lot of money, but when you see the amount of money that there is and all those pools of capital, it's not a frighteningly large amount of money, and that money can be found, including by taking it out of the dirty stuff. And then what can you do? You know, the usual things. This is the Reclaim Finance website. We have a lot of information and actions you can do. Also, Fossil Free California. Sandy will talk to you next about that. There is Stop the Money Pipeline, is a fantastic, huge network of groups in North America working on fossil finance. You can write and talk to your bank, your insurer, your investment advisor or provider to voice your concerns about their involvement in fossil fuels. If you want to make sure your money, especially your retirement funds, are in fossil-free options, there's this great website, fossilfreefunds.org, which will tell you if those funds are fossil-free or not. And if your institution doesn't respond to your pressure, you can change your financial institution. And also writing to your representative, as always, is very helpful. So that is the end of my talk, and I think I'll give it back to Bob.
Thank you so much, Paddy. And we'll be coming back to you obviously with more questions after Sandy speaks. It's now my great pleasure to welcome Sandy Emerson, who's been a delight to work with in our Divestment Committee of San Francisco Bay PSR over the last year on these issues. Sandy is the president of the board of Fossil Free California, and she's a retired software executive and author of technical trade books on database software and operating systems, in addition to this important work. Sandy heads the quote-unquote Move Your Money campaign for Fossil Free California that urges individuals and institutions to move their money out of polluting banks and investments. Inspired by the divestment pledges made for the 2014 People's Climate March, Sandy is a, quote, personal divestment evangelist, unquote, who believes in the power of individuals to align their investments with their values and help speed the transition to a clean energy future. Sandy, the floor is yours, and again, welcome and thank you for being here tonight.
Thank you, Bob. It's a pleasure to be here. And I am going to just share my screen. I have a few slides here. So I've been with Fossil Free California for 7 years now. I am a recovering technical writer in the software industry, and I became aware of the implications of my portfolio during the 2014 People's Climate March in New York City. Fossil Free California works to end financial support for climate damaging fossil fuels. And we're part of the coalition called Stop the Money Pipeline that holds that if you stop the flow of money, you can stop the flow of oil. We want money to be available to promote the transition to a socially just and environmentally sustainable society. The fossil fuel divestment movement grew out of the anti-apartheid movement, and it got a big boost in 2014 during the People's Climate March, which was also the beginning of the first big divestment pledges. The Rockefeller Brothers Fund decided to divest from fossil fuels, which is a really remarkable indication of the strength of their conviction, since their money was derived from fossil fuels. In 2012, Bill McKibben started fossil fuel divestment with his Do the Math tour, saying you have to stop pulling fossil fuels out of the ground. And so you have to choke off financial support for these industries. The divestment movement is one of the fastest growing social movements of this century. And pension funds are, alas, only 13% of the now $14.6 trillion that have been pledged to divest. In 2014, only $50 billion had been pledged, and now in 2021, it's over $14.6 trillion. In 2018, the IPCC estimated that there needed to be divestment of $300 billion annually from fossil fuel production and fossil-fired utilities in order to produce money for investing to stay under 1.5 degrees Celsius of total warming. And this chart, alas, includes investments in nuclear and carbon capture and storage technologies. And we don't think that those investments are necessarily desirable, but the IPCC is still including them. The reason why divestment and shrinking the fossil fuel sector is necessary is due to the business model of the fossil fuel industry. Their valuation depends on constantly exploring for more fossil fuel reserves, and that is part of their business as usual model, with the result that they have already identified about 7 times as much in reserve as we could possibly afford to burn and keep the planet at a reasonable temperature. And if we want to keep the planet below total warming of 1.5 degrees Celsius, at current levels, that would be only about 350 gigatons of new emissions. At the current rates, that would be less than 8.5 years. So the necessity to reduce emissions by half by 2030 is really the figure to keep in mind. Net zero by 2050 is sort of the talismanic pledge that everyone is signing up to, but it's too little too late if without a hard milestone at 2030. All emitters are not created equal, The attribution science can tell you which emitters are responsible for what percent of emissions. As you can imagine, the large sovereign national oil companies like Saudi Aramco are hugely responsible for the development of reserves. ExxonMobil in the United States is a huge potential emitter, and we can even get the attribution down to the individual company level. So if you have to choose what to divest, if you're looking at your portfolio and you have separately managed holdings, start with the big emitters first. Counter to the fossil fuel business as usual model is the enormous growth of socially responsible investing on the one hand and the rise of renewables on the other. Socially responsible investing is hugely popular with investors. It has grown 38% at least in the last few years. There are $30 trillion or more of assets under management globally. And the good news is that the performance of socially responsible investments equal or exceed that of traditional funds. There are resources to be found on greenamerica.org and the ussif.org website. Along with that, renewables are constantly getting cheaper and more readily available. They still represent only a fraction of power production, but their curve is much steeper, whereas the curve of fossil fuel power production is declining. And the crossing of these curves should be around 2025. So why divest from fossil fuels? Obviously, they're bad for the planet. And for at least the last 10 years, they've also been a bad investment. Their production model and the more extreme fossil fuel production methods have not been profitable. That plus investor distaste and overproduction, so that there's a glut on the market, has caused fossil fuels to become an increasingly bad investment. On the other hand, if you remove fossil fuels from an exchange-traded fund, it tracks the same curve as traditional investments and slightly outperforms. In the S&P 500, you can see the decline of fossil fuels by their declining share of the S&P 500. They used to loom large, maybe 30% in 1980. Now they're 2.6%. We are targeting the huge California pension funds, the public employees retirement system, and the state teachers retirement system, and campaigning to get these huge volumes of money to divest from fossil fuels. PERS is the largest public pension fund in the country, managing $400 billion. It has about $30 billion in fossil fuels. STRS, the state teachers retirement system, is the second largest public pension fund in the country, and it's managing $300 billion and has $20 billion in fossil fuels. We're targeting them not only because they're here in California, but because that's where the money is. We have a research wing that presents data to the funds about how much more they could be making if they divested from fossil fuels. And we, strive to make informed public comments at their investment committee meetings. But we also have a grassroots organizing wing. And together with youth allies, we've been really disrupting Cal STRS, the state teachers investment meetings, and doing public protests and marches and petitions. At CalPERS, we have been speaking out at investment committee meetings and making arguments, both financial, particularly financial, because that's what they mostly care about, and also representing their stakeholders, the people whose pensions are at risk if assets are stranded, are speaking out for a livable future and for the financial health of their pensions. On the CalSTRS side, in response to Youth Allies, State Treasurer Fiona Ma and Superintendent Tony Thurman have both publicly endorsed divestment. We're now campaigning to get State Treasurer Ma to express public support for divestment at CalPERS, where she is also part of the investment committee and sitting on the board. Well, what do we mean by fossil fuels and what do we mean by fossil free? The company in the energy sector, fossil fuel reserves represent coal and consumable fuels. The companies in the Carbon Underground 200, oil and gas exploration, production, and integrated oil and gas. But it also includes the supply chain, oil and gas refining, marketing and transportation, energy and equipment and services, and fossil-fired utilities that burn coal or fracked oil and gas. So there's two sort of levels of fossil free. You can have a fossil fuel reserve free portfolio, which captures the reserves, and a fossil free portfolio captures the whole supply chain. So the whole value chain of fossil fuels. As mentioned, CalPERS currently has $30 billion in fossil fuels, about 7% of its portfolio, and CalSTRS has $20 billion, about 6% of its portfolio. We did research showing that over the last 10 years, the fossil fuel holdings at CalPERS declined according to their declining market share as far as percent of disclosed equities. And our study showed that if CalPERS had divested from fossil fuels 10 years ago, it would have had $11 billion more in the fund, or about $6,000 per individual member. And CalSTRS would have had $5.5 billion more, or about $4,000 per member. Our study took the inflows and outflows over 40 quarters and compared returns from the whole portfolio with fossil fuels and the whole portfolio without fossil fuels. So these returns are very specifically calibrated and should be a powerful argument for divestment. The obstacles to divestment from CalPERS and CalSTRS are many, but I would echo Paddy's remarks about their preference for shareholder engagement. With shareholder engagement, even if you are successful, you are asking fossil fuel companies to manage their own decline. And this is not something they are inclined to do. They have resisted, as you know, with disinformation, denial, stonewalling, and every other tactic in order to continue business as usual. So our belief is that shareholder engagement lacks power without divestment as a consequence. One of the country's third largest public pension fund, New York State Common Retirement Fund, is now analyzing its fossil fuel holdings and divesting from those that do not align with a 1.5-degree trajectory. Right now, the CalPERS portfolio aligns with a 3.2-degree trajectory. They have a long way to go. They have to decarbonize their own portfolio, and with engagement, they're depending on the companies in which they invest to meet decarbonization targets. I fear that it's going to be too little, too late. On the other hand, CalPERS is making a lot of pledges and signing up to a lot of alliances like the Net Zero Asset Owners Alliance, and they're part of the Climate Action 100 Plus. So they are precisely identifying the companies from which they need to divest, but they're not divesting. They're continuing to engage and relying on that. The California pension funds are not really accountable to anyone except their shareholders, and they don't have to take a divestment action unless they're directed to do so by their investment boards. So they're part of California government coffers, but the governor can't tell them what to do. The legislature can tell them what to do, but they have to agree that it falls within their fiduciary duty. So there's something of independent nation states, these pension funds. The fact that the pension funds have most of the time not met their return targets means that they're underfunded. They have net accrued liabilities that affect our cities. Cities provide 25% of CalPERS budget, and if CalPERS and CalSTRS don't meet if CalPERS doesn't meet its investment targets, then cities have to provide more. Some cities have taken divestment resolutions asking CalPERS to divest from fossil fuels. This is a lever that will become more important when, if CalPERS continues to miss its return targets. Divestment has been shown to depress share prices. So divestment is sort of a virtuous cycle in which the companies are increasingly seen as undesirable investments. Divestment has expanded into naming and shaming campaigns on the grassroots and national side. And it's also expanded in California to include nonprofit youth and retiree intersection actions, which Fossil Free California is part of that coalition and a few others. For resources, there are podcasts such as Ditched and Drilled, and you can look at the divestment commitments on the gofossilfree.org website. You can look at the divestinvest.org website and our website for other resources. And there are things you can do. You can sign Fossil Free California's petition, whether or not you're a PERS or STRS beneficiary. Please sign, because it simply asks both funds to divest from fossil fuels. You can certainly donate to Fossil Free California. And if you want to look at your own banking and investing, there are a couple of key resources: banklocal.info to find a better bank, and fossilfreefunds.org to look at your mutual funds. Thank you very much.
Thank you so much, Sandy and Paddy. This has been a fantastic course in divestment investment. I have learned so much just in this short amount of time. I would like to open up our event now to questions and discussion, and we welcome any of you who feel comfortable showing your video. We like these events to be community building opportunities, so if you do feel comfortable showing your video, please do. And now I would like to introduce David Bezanson. He is the chair of our Divestment Investment Task Force, and he will be facilitating our discussion. David.
Good evening, everyone. Thank you, Sandy and Paddy, for the excellent presentations. I have learned a lot from them. And they've brought some questions to mind. I'm still waiting for some questions to appear in the chat, so I encourage you to enter them now, but I'd like to pose a question for the speakers while we're waiting for some questions to roll in. A huge amount of funding and ownership of fossil fuel infrastructure and reserves is in the nationally owned oil and gas companies such as Saudi Aramco and Gazprom. What kind of divestment approach is there that could be effective for decreasing the amount of capital that they have?
Yeah, I'm happy to take a bash at that one. That's something that actually I think about quite a lot. And it's a really good question. So the total amount of oil, I think oil and gas equivalents produced by the oil majors, you know, your Shell and BP and Exxon and Chevron and so on is only around 15% of global production. There's more from all the independent, smaller private sector companies. But that leaves a lot of the world oil supply coming from, Saudi Aramco and these other big state companies. And they have a lot of capacity to increase if they wanted to. I mean, they hold, unlike the private companies, they actually hold back their production to keep the price high. So they have sort of capacity that they can quite quickly bring into operation if they think it's worth it for them. I think so. Those big companies do go to the international capital markets. They do take bank loans. They do sometimes issue shares. Saudi Aramco did an IPO, that actually the world's biggest ever initial public offering a couple of years ago, but it was still only, I think, 5% of their shares that were sold to investors, and most of those were actually Saudi investors that bought them up, partly because nobody else wanted them. So I think they are pretty hard to influence through our traditional strategies. We need to actually find more as campaigners and activists. There's need to do more research on exactly how can these oil companies be impacted through this sort of divestment type campaigning. I think one thing would be to broaden our approach from being focused on investments or bank loans to more banking services. I mean, quite sure that Saudi Aramco, for example, is using a lot of the services of banks like JP Morgan and Intesa in Italy, or BNP in France, or Barclays in the UK for running all their bank accounts, holding bank accounts in different countries and doing wire transfers. So I think there's some interesting possibilities there, looking at the long term, that we just basically get the international financial institutions to pull all different types of financial services from them. But I also think, sort of separate from a divestment approach, that as we are more successful, and I believe we will be more successful with the publicly owned, public in the sense of public markets, in that sense, the private oil companies and fossil fuel companies, as we get more successful and them taking seriously these like net zero pledges and so on that they're taking, and actually pulling out of fossil fuels or just going under, that we are going to have to turn more attention to the demand side of the equation. And it is already happening. There's already groups working on demand, but there's some areas, for example, plastics, where the oil and gas industry is seeing that's their big area of growth. I mean, they're sort of terrified by electrification of vehicles, and they see big demand drops coming from that, but their optimism comes from plastics demand, and they have these insane projections of how we're just going to keep consuming more and more plastics. And of course, the feedstock for the plastics is oil and gas. So staunching the demand for plastics and reversing that, reducing plastics demand, for example, would be very important. And there's financial strategies can be used in that, in terms of stopping these new petrochemical plants that are to produce plastic feedstocks, refineries and cracker plants and so on.
Oh, thank you. Oh, David, we can't hear you. I think you're muted.
Thank you, Paddy. Sandy, did you want to comment on that?
Yeah, I wanted to say that I took great heart from the fact that nobody wanted to participate in Saudi Aramco's IPO. And when Saudi Arabia and Russia were in this hyper production standoff phase just before the pandemic, and increased the oil glut, so that no one was making any money, and tankers full of oil were parked off of people's coasts. Saudi Aramco eventually blinked and ratcheted back production. I'm sure that they are confident they'll be the last oil company standing in case of policy and preference coinciding to reduce demand to a very low level. That said, they're not stupid, and they've been investing in renewables as well. So I think that they want to survive the transition, and they could, a scenario could be posited where they're just using their domestic oil for domestic uses.
Excellent. Thank you, Sandy. Well, looking at the chat, I can see a few questions. So let's start with the top of the stack. A question from Thomas. How big a success was the recent investor action at Exxon? And could it have happened if the people behind it had divested?
I'll take a stab at that. The investor action at Exxon from engine number one was supported by CalPERS, CalSTRS, and the New York State Common Retirement Fund. Engine number one itself had only a sliver of shares. Many more shares are held by CalPERS, CalSTRS, and the New York State Common Retirement Fund, which has not yet divested from Exxon. And it's an interesting question whether that action would have been successful without large share owners flexing their muscle. But I think also the time was right, and BlackRock and State Street and Vanguard eventually made vote the new slate of activist directors recommendations when BlackRock dwarfs in terms of shareholding any of these pension fund shareholdings. I think it's a very fraught question as to whether these new activist directors will actually change the culture at Exxon or cause Exxon to change its plans. They will continue to be in the minority, and all three new directors have ties to the fossil fuel industry. And so we'll see. I think if CalSTRS, CalPERS are determined to engage, obviously, they only need a fraction of the shares that they currently hold. Do you have any thoughts, Paddy?
Yeah, I mean, I think that engagement and divestment really have to go hand in hand, because without the threat of divestment and the actual divestment and the fact that 14 trillion whatever dollars of investment has already happened, that's what makes the companies sort of look up and take seriously the engagement discussions. So I think the two things are I mean, they're not mutually exclusive, and quite the opposite. They're mutually reinforcing. And it also can be done inside the same institution. So Legal & General, for example, which is a huge UK asset manager, they have sort of a family of green funds, which is very progressive on divesting. They put companies sort of publicly on notice, and then if they don't change their ways, they divest from them. But they still hold on to them in other funds, and then they can vote against the companies with the other funds. So there's ways that actually inside the same institution you can do both. And then you can also set deadlines. This is happening now increasingly in the coal sector, in that the asset managers are saying, if you do not get out of coal by 2022, 2023, whatever, then we will divest you. So it can act as a lever to push companies with coal assets to get rid of them. But actually to shut them down. That's another thing. We don't want companies that, for example, have coal assets to just sell them off to somebody else, which has happened, and then the other company operates them. We want the companies to actually shut them down with just transition plans for workers and communities and so on.
All right, thank you, Paddy. We have another question in the stack. This is from Patrice. The amount of assets in private hands in Paddy's presentation is chilling. Are there any efforts to get this money divested?
Yeah, you go, Sandy.
Oh, okay. The Divest, Invest, Individual campaign has been puttering along for years, and many billions of dollars have been pledged to divest. But in my view, there's really a lot more that can be done with individual investors. More investors want to move their money. Usually their financial managers make it very difficult. So the first thing you have to do is train your financial manager to look for different investments that align better with your values. I think that once big investors start the ball rolling, that a lot of money could move out of fossil fuels that's currently held in individual portfolios, in individual bank accounts, and in individual donor advised funds. There's been a lot of campaigning recently for donors who open a donor advised fund to don't just let it sit there, but let it do some good in the world and invest in a socially responsible manner.
Yeah, just to add, I mean, there are some very wealthy individuals and families have divested. The Rockefellers would be the best example of that, both sort of institutionally through their foundation and individually. And the Rockefeller family is very active in divestment circles, and they also have their own organization now called Bank Forward, which is specifically aimed at banks, in particular JP Morgan Chase, because they have a long relationship with JP Morgan Chase, including because David Rockefeller was the CEO and president of Chase Bank, or Chase Manhattan, for a long time. But at the same time, there's a lot of that money which we're not going to reach. A lot of it's owned by Russian oligarchs, and it's illegally squirreled out of countries by dictators, and it's just a lot of hot offshore money of very dubious provenance. And fortunately, we're not that money's not going to do anything for moral purposes. But having said that, given that the return on fossil fuel investments has been so poor that maybe even those Russian oil and gas oligarchs are going to see that they're better off without their money invested in fossil fuels.
Thank you both. We have another question, which I hope we have time for, because I want to hear the answer. This is submitted by Bob. Does the apparent failure of the recent Biden summit with world leaders as regards to not getting stronger pledges to reduce fossil fuels and put limits on coal send a signal to asset owners and managers that they can hold on to their portfolios?
Well, I'll take a swing at that. I think, yes, it sends a signal of deep disappointment from everyone who hoped for more. But we have Glasgow coming up, which will send a different signal. And I think the COP26 in Glasgow, I hope, is not similarly lackluster just because it's international. A lot of campaigns are focusing on that November timeframe, and I hope that they will send a countervailing signal. The G7, I guess they just settled in for their comfortable, do as little as possible sort of mode. And it's the same story with our comfortable and complacent pension funds, I have to say. Rather than take bold action, they would prefer just to wait and see.
Yeah, I would add that the lack of a strong political action, especially in the US, is certainly dispiriting and does slow down things on the financial side. But at the same time, it just makes the financial campaigning even more important, because we have, even through the awfulness of the Trump years, we were able to get a lot of action still on the financial front. And ultimately, if investors and bankers and insurers don't want to be involved in the fossil fuel industry, that will be very important in bringing it down, and that can happen without government action. I'd say some of the more frightening things here is there have been efforts from the Republicans to try to actually put in place regulations and talk about legislation to actually stop banks from not financing fossil fuel companies. And I don't think that's actually going to happen in terms of legislation, but under a new, if there were to be another Republican administration, they could put in place regulations, which is a a depressing thought, but at least you know there's a lot of finance from outside the US, which is not going to be influenced by that, and you know it's not really going to be possible for a US government to, unless they nationalize the banks, which probably the Republican administration won't do. They can't really force them to put their money into fossil fuels.
Excellent. Well, I don't see more questions in the chat.
Oh, I think there's one more, David.
Oh, here's one.
Oops, you hit mute.
Any thoughts beyond decisions on personal investments on the most impactful actions that health professionals can take at this time?
Well, I would just say, I mean, I think just the work that's already been done stressing the horrendous impacts on mortality and morbidity around the world from fossil fuels is incredibly important. And you know, as an example of how things could change, this recent International Energy Agency report on net zero pathway by 2050, which just came out in May, is incredibly important because the International Energy Agency has historically been a very pro-fossil fuel body. It was set up by the rich oil producing companies after the oil crisis in the 1970s to basically ensure oil supply, and they have come up with this pathway saying, we don't need any more investments in fossil fuels. And they also say that with their net zero pathway, I think it's 2 million lives a year would be saved by transitioning to clean energy. So I think for health professionals to be stressing that message that there are all sorts of benefits other than climate from transitioning to clean energy and doing it quickly.
Sandy,
I
did
would
you want to
say,
comment?
yeah. There's a group called Climate Health Now that some of you know about. And Climate Health Now is asking health professionals to look at their insurance and their retirement plans and the endowments of their institutions and hospitals and seek to divest those from fossil fuels. I think it's really encouraging that the United Nations Joint Staff Pension Fund just decided to divest from fossil fuels, and that institutions such as the Federal Thrift Savings Bank are going to concentrate on, are going to offer a fossil-free option to their for their retirement, people's retirement savings. You are all part now of institutions, and you need to know where your retirement savings are invested and what that represents.
And I just want to add, there's a great report by Physicians for Social Responsibility titled "Running Out of Time: Why U.S. Health and Life Insurance Companies Should Divest from Fossil Fuels." And I just put the link in the chat for everyone.
Excellent, thank you. Do we have time for another question?
We do have time.
Good. This is for Sandy. I noticed in your slide set that CalPERS and CalSTRS are invested to the tune of about 6%, 7% of their total portfolio in fossil fuel related debt and equity investments. Whereas on the other hand, in the S&P 500, the composition of that is only 2.6% fossil fuel. So have they made any comment about why they're electing to have 2 to 3 times the amount of the S&P percentage in their portfolio?
They don't comment on their asset allocation, but it is their asset allocation that is, and particularly their active investments, that's driving this percentage. Most of their equities follow the benchmark, but they're not using the S&P 500. They're using a custom benchmark based on a global benchmark with certain tweaks. And so we have to analyze their whole portfolio: cash, private debt, private equity, bonds, and equities, domestic equities and international equities, to get that kind of percentage. It's sort of a painstaking grooming of and categorizing of all of their thousands of investments. And that's what it comes out to. Particularly with bonds, they have a preference, oddly enough, for maturity dates that are way in the future. So they have a hefty percentage in debt securities, and many of them don't mature until 2040 or 2050, some even after 2050. And I would say that the increased tendency to invest in private markets is only going to exacerbate the problem, because in those markets, you don't get your payout until the partnership period is over. And so you cannot really remove your money until the prescribed length of time has elapsed. And you don't know what you have, less knowledge of what's in there. The state of Maine did just pass the first legislation in the country to divest its pension fund from fossil fuels. And the analysts found that the state of Maine was investing, maybe half of all of its assets in private markets. And that's where all the fossil fuels were. They found that that's where the fossil fuels were located.
Thank you.
Well, I think if there are no more questions, any last questions? Well then, thank you, Paddy and Sandy and David, and I think Bob might want to say a couple last words.
Well, just want to thank everybody for this very informative and comprehensive presentation. Obviously raises a lot of questions for us individually and for the work that we're doing with our institutions. I know there are a number of people who are on the call tonight who've been very active, like in UCSF, or I should say UC, wide divestment struggles, and we're hoping to continue working with physicians and other health professionals to move the needle on all of this. So I want to again thank Paddy and Sandy, and as well Julie, you and Tara Weeks, and our intern Daisy Valdivieso for your great work on this and all the other webinar presentations we're having. And just turn it back to you, Julie, for some final remarks.
Bob, thank you everyone for coming. Check out our events page for more information about our upcoming events, and we hope to see you again. Take care. Good night.
Thank you, everyone. Thank you, David.
Thank you.